Hello and welcome to CMC Markets Trading Outlook for the week of March the 3rd, 2015. My name is Colin Szynski, Chief Market Strategist. This week's topic is to cut or not to cut. That is the big question for the Reserve Bank of Australia and the Bank of Canada this week. There's actually four big central bank meetings scheduled for this week. Australia and Canada are both widely expected to cut interest rates by another quarter point, having done so at their last meetings. And the Bank of England is expected to hold steady. The ECB is not expected to do anything after their big quantitative and easing announcement last meeting, but the ECB is expected to start getting its quantitative easing program going. So people may look to President Draghi's comments for more insight into when that's going to start and how they're going to proceed from here. The other big thing this week is U.S. employment rates data comes out with the ADP payrolls on Wednesday and the non-farm payrolls on Friday. We also kick off the week on Monday with purchasing managers' reports from around the world. We'll note there is not Canadian employment this month. The first week, it's not until next week. Canada's a week later this month, so just note that Friday will be a sole focus on U.S. non-farm payrolls. And we'll remind everybody that I do have a live webinar with Michael Hewson starting at 8:15 a.m. Eastern Time on Friday for the non-farm payrolls. That's 1:15 p.m. GMT for people in Europe. Moving on now, I'm going to start looking at the dollars. I'm in particular with the Canadian dollar, the Australian dollar, and the Kiwi dollar. As I said, both the RBA and the Bank of Canada at their last meetings surprised the market, going with quarter point interest rate cuts to help to boost their economies and deal with the slowdowns from falling commodity prices. In the case of Australia, more on the metals prices, and in the case of Canada, due to energy prices. There's a question now, though, this time around: will they follow through with an additional cut or not, or are they happy with what they've done so far? The Australian data that's come out since the last RBA meeting has generally been positive. Particularly, the employment report was better than expected, and the February purchasing managers report for Australia showed some improvement as well. In terms of Canada, the data has been more mixed. The Canadian retail sales report was particularly weak. Employment data has been up and down and quite scattered. But recently, Bank of Canada Governor Poulos suggested that the one cut he did do, what he saw as more of an insurance policy, and that obviously based on that he was more interested in taking a bit of a wait and see approach to see if he needed to do more. That suggests that he's probably less likely and less inclined to deliver a second rate cut at this week's meeting. The other thing to note in terms of inflation in both Canada and Australia, core inflation has held up quite well and quite high, up towards or above the 2% range. So there's not an inflationary reason or basically a fear of deflation reason for interest rate cuts in Australia or in Canada, unlike in Europe, where there is a real fear of deflation has pushed the ECB into launching its quantitative easing program. So what have we seen with the resource dollars based on this? Is we started to see some speculation or basically speculation of further rate cuts starting to ease a little bit. And I'll show the charts in a minute, but I just wanted to start with the client sentiment for the three resource dollars here. So we have Aussie dollar in the middle, CAD and Kiwi dollar, and as you can see with all of these, we still have people pretty short against them, and we have a 94% sell among top clients against the Canadian dollar, 88% against the Aussie dollar, 96% against the Kiwi dollar. These are getting to be pretty crowded trades, however, with nearly everybody in a position value looking at it from the short side. That suggests there is the possibility that even though the street is widely expecting additional rate cuts out of Australia and Canada, the surprise would be if they didn't cut, if they maintain interest rates where they are, and either central bank may continue to, the Australians may continue trying to talk the dollar down. Canada has said they're only interested in the free-floating currency and don't really get as involved in that. But at this point in time, the surprise seems to be that perhaps they don't cut, and that could then spark rallies for the dollars. So let's take a look at the charts here. We will start with U.S. dollar CAD, which is actually rolling over. we can see here. If we look at the chart here, it's had a huge run up as oil prices came down. Dollar CAD. This is the run up is CAD weakening and U.S. dollar strengthening against CAD. So massive run up here from $1.08 last summer up to $1.28. But over the last little while, we're seeing it level off. We've got a trading channel forming, and we've also basically got a nice little descending triangle here forming. Lower highs above support at 123.65. And as we see, and here if we look back at the RSI, the dollar had gotten extremely overbought. It's worked its way back kind of to neutral, but basically the upward momentum has been fading, and there's a possibility of a downturn here. If we did get a downturn, first supported the 23% retracement just below 123, and this 50-day moving average here is about 121.85. So we are seeing some potential for a reversal here in dollar CAD. Now, if we move up and look at Aussie dollar, we're starting to see some base building as well, which I'll show here momentarily. So Aussie dollar had been falling in a step pattern here, sell-off, consolidation, sell-off, consolidation, sell-off, consolidation. It's been looking more recently like this could just be another pause in the staircase pattern down, but we have seen it peak above resistance here at 78.65. Really, it's probably got to get through 79 to suggest a more serious increase. But this is a small double bottom here, a bit of a saucer bottom forming. We had a small positive RSI divergence here. So suggesting overall a number of signs suggesting that perhaps this big downtrend was starting to run out of gas a bit here, and we're starting to turn higher. We get above 79, 80 is first round number resistance, and the 23% retracement is in and around 80.60. So there is a bit of room for a bit of a pop here. The RSI is basically showing that downward pressure has been easing against the Aussie dollar, but it still has to get above 50 to confirm an upturn. Moving now, we'll take a peek at the Kiwi dollar as well, where we've also seen some of the negative sentiment of late start to fade against the dollar as well. In the case of the RBA and Z, they raised rates 4 times last year. They have lots of room to cut interest rates if they want to. Part of the initial sell-off here was the RBA and Z directly getting involved in the FX markets and actually selling the dollar down. They've gone a step farther beyond talking the dollar down. They had actually intervened last summer, as they had in early 2013. We'd seen it consolidate for a while between 76 and 80. It's had another down leg washout more recently, but it has picked up some support here about 72. It's creeped above 75, which is showing some signs of support here. And we do, and this is 23% retracement, 79, and we do seem to be getting an ascending triangle base forming below that. RSI has peaked above 50 and staying, which is also encouraging, suggesting that upward momentum is quietly starting to build in the New Zealand dollar as well. If we did get a breakout, first resistance possible in around 77, and the next 38% Fibonacci retracement is in and around 78.25. Which with a and this here, the 72 to 76 ascending triangle could measure you up to 80, which is a 50% Fibonacci retracement up here. So there is potentially some technical upside. The question with the Kiwi dollar remains, what level is the RBA and Z comfortable with? At what level could they start to take pot shots at the dollar again? Traders are looking at it from the long side do need to be aware of and be careful of that. Well, we'll now shift gears and take a look at Europe and gold. That's another big story this week. As I noted, this is the ECB had at its last meeting announced a 60 billion euro per month quantitative easing asset purchase stimulus program to come in. That's supposed to start March. Well, this is the first week of March, so they should be getting started. The ECB does have a meeting this week, so perhaps they'll talk more about how they're going to get started. I was looking earlier today at the ECB's balance sheet. It had a bit of a bump up in December when they did their last LTRO auction, but since then it's kind of been flat. So once again, they need to start showing that doing a lot more talk and doing an actual lot of serious stimulus that will actually show up in the numbers, which it hasn't to date. The street's likely going to give them a little bit of a break here and a bit of benefit of a doubt. They've been doing it for 9 months, so why not a few more weeks? But seriously, they'll probably give them a few weeks to see, or we do starting to see the balance sheet actually tick up. So far, the street seems to be thinking that yes, they are actually going to do it this time. Because what have we seen? We've seen the DAX break out to new highs. We've seen gold start to pick up, and we've seen the euro falling. So those, I'll bring these up as and show what's been happening here in terms of client sentiment to start. We've got here on the DAX, we've still got some mixed sentiment, but we've got all clients 83% sell on position value. That's come down a little bit. Top clients 68% short on position value. So, and top clients in terms of numbers are a little closer to 50-50. So people are a little bit questionable about what's where could the DAX keep going from here, or is it due for a correction? The U.S. markets have leveled off, which I'll show in a little bit. But the European indices have kept on going. It's possible they could get ahead of themselves, but they do have QE support. The question is how much QE has already been priced in to European indices. If we look at the euro dollar, it's come under pressure again. We've seen the short positions here starting to creep up over the last little while. Top clients 87% up a little bit. All clients 72% short, up 5% today, and even all clients here on the number of clients is starting to creep up. So as we're moving into the potential launch of the euro quantitative easing program, we are seeing people starting to go bearish on euro dollar again on anticipation of increased European money supply. Gold was also an interesting one because, of course, gold had a big rally on the announcement of the QE program. Then it had a setback when you had the Greece situation resolve itself, and but now that Greece has gone back to the back burner, people are back focusing on the ECB's balance sheet. Gold is starting to creep up again, and remember, over the last 5 years, gold's trend has basically followed the ECB's balance sheet up and down. The Fed just kept on going and adding and adding and adding, but gold did not follow the Fed higher forever. Gold turned lower when the ECB bank ran their stealth taper for a couple of years. Now that they're talking stimulus again, gold is starting to pick up. What have we got here? 75% long for top clients in terms of position value, 80% long for top clients in terms of actual number. So people are still looks like people are still pretty bullish on gold here. So we'll take a look here at gold as well as the euro dollar and the indices, particularly the DAX. If we look here, we have the gold to start with. So gold had a big run here at the start of 2015, heading into the announcement of the ECB's QE program. It came off, even as the Greek situation people realized it wasn't going to spiral out of control. So that's pulled off. But look, we've got a higher low here in and around 1190. Really, it's holding about 1200, and this trend support has been holding as well. What's interesting is it was only one day it really dipped below this trend line, and otherwise it's actually been holding it. So that's encouraging. We also had a downtrend here in the RSI that's been broken. This has started to turn upward. Needs to get up to above 50 to confirm, but it looks as though the correction has run its course for gold and the uptrend is starting to reinsert itself. Gold today is back up above 1210, emerging as higher support. First resistance here around 1220, and then in and around 1235, and potentially room for further upside for gold. I'm just going to actually draw a couple of trend lines on here that could be of interest here. So gold has been coming down here, and as we can see, it's just about it's testing and could break this downtrend line here. It needs to clear 1220 to really do so, and similarly here on the RSI, it's already broken out of its downtrend here. So a move above 50 would confirm an upswing. And moving past euro now moving past gold to the euro dollar, which we'll see here. We'll see that it's actually starting on another down leg. It's been generally weakening for quite some time. If we bring it here, though, we can see we had a big sell-off December, January ahead of the QE announcement. It leveled off. More recently was trading 113 to 115. The broader channel is 111 to 117. It has rolled over and started to break down on the pair and we had seen here had gotten hugely oversold. You got your technical bounce, however it's stalled well short of 50, so the broader downtrend remains intact, and it started to roll over again, suggesting downward pressure starting to increase once again, and it looks like euro might be heading for a downline. Possible we'd be looking for a retest here of 111. If we retest 111 and it holds, you've got a really nice double bottom. If it fails, then you've got the 110 round number in below that. Just I'll highlight a couple of actually before I go into indices, I'm just going to show cable here while we're talking about European currencies. The relatively speaking, on euro pound has continued to trend lower because look at this. While the euro's been trending downward again, the pound is starting to recover. There's been the chatter out of the Bank of England seems to be that at the very least they're certainly not going to go to any more stimulus, and there is the possibility that that they're looking at a rate hike at some point down the road. Whether it comes this year or whether it comes next year, still hard to say. Certainly not the first half of this year. Maybe towards the end of 2015. Maybe it slips into 2016, but there's still enough members at the Bank of England that think their next move will be a rate hike that we are seeing this stabilize and actually starting to creep up. So it's broken out of this downtrend again. I'll just draw in a little longer term line here to show how the cable has broken out and is quietly working its way higher. Support's moving up here from 153.25 to about 154. This is a 23% retracement and 155 round number here. And then this is 156, and this is about 157.50. And we can see RSI is confirming the upturn in momentum for cable. So, and actually, I will just show euro pound because I think it's worthwhile to highlight what's been going on here, which is this: a pretty solid downtrend going on here with the pound continuing to outperform the euro. Now, it is getting a little bit oversold on the RSI, so maybe we get a trading bounce up to 73, maybe even 74. This is the 10-day moving average here is in and around 73.50, but it still appears as though this primary downtrend remains intact at this point in time. Let's shift over to indices now. I'll do the Germany 30 and I'll do the Dow to show the difference here between the two. So Germany 30, continued outlook for European stimulus, continues to break out to new highs. Even here on Friday, it's broken out again. And we do have RSI getting overbought, negative divergence starting to emerge, could be getting vulnerable to a correction here. It's at 11,390. Maybe it comes up and tests 11,500, maybe not. And but at some point, it could be vulnerable to a pullback. If it does, looking for support here, maybe in and around 11,180 to 11,200 zone, then the 11,000 round number in and around here. The other reason why the DAX looks like it might be getting ahead of itself is if we look what's going on with the Dow. The U.S. indices have leveled off, and there's a lot of U.S. data this week. The focus is going to be on the employment numbers, ADP, and then non-farm payrolls. Purchasing managers also could have an impact on the market. But what's happened here with the U.S. market? Leveled off. Massive rally up off the October low. Yes, we've seen it hit new highs recently, but they really haven't been that enthusiastic. Cleared 18,100, got to 18,250, and it's stalled again. And what are we looking here at the RSI? It's gotten up about 60 and starting to roll over and stall again. 40 to 60 range, as we saw through here, indicative of sideways momentum. So yeah, we've peaked up to a new high, but it hasn't been very enthusiastic. What will the Fed be looking for? Strong employment numbers would continue to point to a mid-year liftoff for interest rates in the United States, particularly say in June. The Fed Chair Yellen recently said she was continuing to be patient. Patient meaning 2 meetings. Well, 2 meetings now is the March meeting and the April meeting, so she's left the door open to June. A lot of Fed speakers have been out talking June, and if you see a strong employment number, June could still be on the table. If you saw, and strong, I mean 250 plus on non-farm payrolls. And to really change the thesis on this, to change expectations, would really require a number below 200 at least for this train to be slowed in any meaningful kind of way. So 18,240 resistance here for the Dow. First support in and around 18,100, then the 18,000 round number level for the Dow. The final thing I'm just going to take a peek at here quickly and show our energy prices. Just to, we'll look at these just technically to wrap up the week. I'm going to look at WTI and I'm also going to look at natural gas briefly here. So, WTI, massive sell-off. And what are we getting? Remember, I was talking just a minute ago about the 40 to 60 on the RSI. Here's 40, here's 60. The momentum on WTI is starting to go sideways. Still very choppy. Still an excellent traders market. Good intraday and between day moves here. 43 on the downside, 55 and change on the upside. Basically a 45 to 55 channel. Support here in and around 47 to 47.50. This is $50, and up here is in and around 53. So there is some support within this range, but basically we're continuing to look at both Brent and WTI to continue trading sideways and continue to be fairly volatile as the price war among suppliers continues. Last chart of the day I'm going to bring up here is natural gas, which I just wanted to highlight here. The seasonal rally this year didn't last very long. Mid-October to mid-November, you had a double top. It's been creeping lower ever since. And even though February has been blisteringly cold, February, where I am here, the temperature has not gone above freezing for the entire month. And you know what's amazing about that? Despite that, for the entire month, natural gas has been unable to break back through $3. People are clearly looking past this heating season into shoulder season, and we're starting to see some weakness here. Even with incredibly cold week a couple of weeks back, and incredibly cold week on this week that's just ending, natural gas has been unable to punch above $3. Huge resistance in this range, so it does look vulnerable here. First support is in and around the 250, 255 area for natural gas. So that wraps up this week. There's going to be tons to talk about. There's tons of data. There's tons of central banks. There's lots of potential for surprises, and because of that, we could see quite an active week for trading.